I'm out research monthly call for July 2023. Hey everybody, Willie Dowich here. Thanks for tuning in. Thanks for listening. It is time again for our monthly call here at High Mount Research, where we go through not just the topics of the day, but kind of zoom out a little bit, look at what we're seeing from a tactical perspective, what we're seeing maybe from a strategic perspective, kind of try to make some sense of it, discuss portfolio changes we've made, that sort of thing. And certainly this month more than ever, I think we've got lots of stuff to talk about as we look at some of those differences in terms of market outlook based on time frame. We'll get to that at the end and try to, over the course of the call, try to make some sense of what we're seeing in terms of different messages from the market, whether we're looking at macro conditions or more market-based conditions, whether we're thinking about a tactical time frame or a more cyclical or strategic time frame. So you can see here the mix of topics that we have on tap today. A couple things to highlight here. This cooling inflation, we got inflation data earlier this week. We're going to go through that. That could provide some relief for consumers, also provide some relief from the Fed if kind of the good vibes that we're getting from last month's inflation persist as we go forward. The investors' embrace of the rally. We'll look at some ETF flow data that I think does a good job of summarizing this shift we've seen in investor sentiment over the past 6 weeks or so. And then this idea of breadth broadening, look at what's happening at the median stock in the S&P 500, look at what's happening from our fear of strength model perspective and what that means for mid caps as we go forward. So let's get into it. Lots to talk about, lots to consider. Before we get into that, let's kind of zoom back and just think about the second quarter for a moment. So we shared a version of this dot plot several times over the course of the quarter. We have on the x-axis, we have market strength. On the y-axis, we have market volatility. So we're comparing the number of days in each quarter in which we have new highs greater than new lows. Compare that to the percentage of days in each quarter with moves on the S&P 500 of 1% or more. You can see the first quarter of this year highlighted here. It was within the norm of kind of what we've seen over the past 20 some years. Not near the average in terms of the trade-off, but certainly within the normal environment. For most of what was Q2, we were well outside the norm. As the quarter wound down, we actually got closer to kind of this outer boundary of what we might consider normal, kind of a 90% threshold, roughly speaking. We're still on the outside of that. So we finished with a little bit more of a normal feeling for the quarter than we had early in the quarter, but still not quite what we would typically consider as within the bounds of recent experience. We can just think about the year overall, the first half of the year, and that actually is looking relatively consistent with this trade-off between strength and volatility that we've seen over the past year. We're looking at 50 some years. This is yearly data. Just for reference, last year was 2022. It was normal, even though the relationship was normal, even though it was an extraordinary year in terms of the amount of weakness that we saw. The amount of volatility that accompanied that weakness was not out of bounds. And so what have we seen now as we've gone through the first half of the year and starting to see more consistent evidence of it as we go into the second half of this year? Is this subsiding in day-to-day volatility? We've seen this uptick in strength. Now we're starting to see day-to-day volatility subside, and stocks typically do well when that happens. We had a 7-day streak back in November in which the S&P didn't move more than 1% over the course of 7 days. Now we're starting to get a cluster of it. We still haven't had that extended run like we saw multiple times in 2021. And if we zoom back over history that we've seen when stocks are in sustained uptrends, but certainly a different environment over the last 6 months or so, certainly over the last 3 months than what we saw for most of last year. And that's encouraging. This quiet markets tend to be strong markets. That I think is something we forget, that the fireworks of big moves, whether they're up moves or down moves, is not typically something you see in strong markets. Strong markets tend to bore you to death, tend to lack day-to-day volatility, don't have big swings in either direction. So seeing this emerge over the past quarter or so, this consistent quietness, I think, is an encouraging sign as we go into the second half of the year. From a kind of a cyclical and strategic perspective, we like to weigh the evidence. We're going to go through each of these now in some detail, but just to refresh your memory, last month we had two on the bottom. We had breadth as neutral. We had sentiment as neutral. This month, both of those kind of get on one side of the scale and they offset each other. We see breadth over here now with trends and momentum. So these really the market-based measures that we're looking at, they point to opportunity. That I think helps explain some of this tactical strength that we're seeing in the stock market right now, while some of the longer term, the macro influences, and now we can include sentiment in there, are on the risk side of the scale. So from a strategic perspective, from a discretionary asset allocation perspective, lots of cash on the sidelines, not wanting to fully embrace the strength we've seen so far this year. Though on a shorter term basis, the message of the market is, lean into that for as long as it lasts. So we'll get into it. First, liquidity. We talk about not fighting things. Don't fight the Fed. Don't fight the tape. Here's just an indication of why it doesn't pay to fight the Fed. On the bottom here, that's a percentage of global central banks are raising rates. Uptick there. That's Turkey joining the rate tightening club. Now I think we've got Japan and we've got China as the outliers there of not raising rates at this point. And the results speak for themselves. And the 1/3 of the time since 1990, when a majority of central banks have been raising rates, the S&P 500 has gone basically nowhere. Virtually all the net gains are when most central banks are cutting rates. And so even as we have this conversation about, is the Fed going to be done after July in terms of raising rates, that's just part of the conversation. That's just the Fed, and that's just stopping raising rates. The tailwind from the Fed, the tailwind from central banks come when a majority of them don't stop raising rates, but actually start cutting rates. And just from a liquidity perspective, need to understand that there's, even if the Fed is done raising rates, there's still work to be done in terms of draining liquidity. Orange line here is the Fed's balance sheet. Yeah, it's at a 2-year low and it's starting to roll over, but it's still twice what it was pre-COVID. So there's still that liquidity that needs to be drained out of the system. That likely persists for a while. And whether the Fed is actively raising rates or not, this liquidity environment of the past few years, prior to a year ago, and really the past generation, where there was this persistent upward bias in terms of Fed liquidity, probably isn't going to be there for a while. So liquidity conditions are, even if they're not as tight as they are now in terms of lots of tightening of rate, lots of raising of rates, lots of draining liquidity, they're not likely to be super friendly anytime in the near future. From an inflation perspective, this is a median CPI. So this kind of gets released a little bit after the headline data. And I like to wait to see this because it gives a sense of what's happening in the middle, rather than giving that initial reaction right at 7:30 Central Time after the BLS releases data, and you start to pick and choose which series you want to include, which ones you want to exclude, and start looking at used cars and eggs and all sorts of other various data points. I'd like to look in the middle. And the takeaway from last month's data was actually really encouraging. There's a 0.1% increase on a month-over-month basis in the middle of the distribution. That's the lowest, I think, since November of 2020. 3-month annualized change is down to 3.6%. 12-month change down to 6.2%. So we're seeing some relief in terms of inflation, not just the outliers, but actually in the middle of the distribution. Can that persist? We'll have to see. And the Fed's likely to look past some of these short-term fluctuations and want to be sure that longer-term trend has indeed started to roll over. But at the same time, inflation coming off is helping and provide some relief for workers, for consumers. Here we're looking at the top at real average weekly earnings. So this is hourly earnings and then adjusted for average hourly week, average weekly hours worked. And we've talked about this before on a real basis. We've been hanging out basically where we were pre-COVID. We had a surge and a decline. You look at it on a 12-month basis. We're actually now positive on a year-over-year basis for the first time in 2+ years. Some of that is because June of last year was super low. But again, if inflation is cooling and the labor market is staying relatively robust, this could start to move higher, and there's room for it to move higher. You look at the discrepancy between what's happened on a nominal basis and what's happened on a real basis in terms of average weekly earnings. It's pretty staggering. On a nominal basis, and so this is kind of the take-home pay that we're seeing. On average, it's up 20% from where it was prior to COVID. In terms of purchasing power, it's unchanged virtually since pre-COVID. And so that's the nefarious part of inflation. It makes you feel better. It can influence behavior because you see the numbers that you're bringing home, but you're not getting any more. So you sense of doing better, even though you might actually be falling behind. From thinking about what this all has to do in terms of earnings and the prospects, because that's really the key. The key between the economy and the stock market is really what earnings can do, and then ultimately what investors are willing to pay for those earnings. And it's earnings season again, so looking at profit margins, I think makes some sense as we go forward, as we think about strong labor demand, what's happening in the corporate sector. What we're seeing is profit margins. This is GDP-based profit margins rolling over. You take out the COVID exceptions there. And for Q1 of this year, profit margins were their lowest level in a decade. And so it's going to be hard for companies to beat some of these elevated earnings expectations if profit margins are coming under pressure. And so that's the risk in the economy right now. The risk for the market right now is kind of this uneven growth that we're seeing in the economy is compressing profit margins. If that continues, it's going to be hard for companies to deliver what right now is expected, a median earnings growth of like 16% over the coming year. That's a challenge in an environment where headline growth isn't that great and profit margins are being compressed. Here's a earnings revision trend for the S&P 400. This is a key thing to pay attention to. Don't worry as we go into earnings season about what happened last quarter. I know that gets a lot of focus, whether a company beat by a penny or missed by a penny. Lots of analyzing of that, lots of analyzing of those beat rates. I think what we actually want to pay attention to are these earnings revision trends. Are coming out of earnings, companies raising guidance and analysts raising those estimates, or are they having to bring them down? This, like I said, this is for the S&P 400. It did not break out to a new high, even though we see the index itself trying to, and now is starting to roll over. If this turns lower and stays lower, it's going to be hard for prices to continue to celebrate at a time when earnings revisions are trending lower. Relate that all to valuation, stocks versus bonds. I think this is a really important chart, in part because it shows a difference of environment that many investors are not used to, and even folks like me. I've been around 2+ decades now. It's been a long time since I've seen something like this. The top line here, that's the S&P 500 forward earnings yield. So that's the PE ratio, the forward PE ratio turned upside down. So earnings over price, that's 5.3% for the S&P 500 over the coming year. The orangish line, that's a 1-year treasury yield. So what you could get over the coming year from treasuries, that's 5.4% at the end of June, which means the treasury yield is actually higher than the earnings yield for the S&P 500. We think a lot about earnings risk premium. What this suggests isn't an earnings risk premium, but an earnings risk discount, or perhaps a bond risk premium. Not something we've seen, again, going back to the early 2000s. So we're coming out of this environment where rates were super low. And relative to bonds, stocks were relatively cheap. That is no longer the case. And so, as we think about portfolios, as we think about asset allocation, and step back from some of the day to day of what's happening with yields, what's happening with stocks, it's excuse me, important to keep in mind that from a valuation perspective, bonds are more attractive now versus stocks than they have been at any point in the past 2+ decades. That isn't keeping that value, those valuation issues aren't keeping investors from turning more optimistic about stocks. Here's our kind of summary of three of the main sentiment surveys that we like to look at the top here. That's the S&P 500. I'll explain the horizontal lines in just a moment. Blue line, that's the NAIM exposure index, popped above 90% this week. Orange line is the bull bear spread among advisory services. That's the investors intelligence data. And green, that's the bull bear spread among individual investors. That's the data from the AAII. And so horizontal lines here, let's go back to those November peaks, November 2021 peaks. We're at or near the highest levels since those peaks. The question is whether we continue to zoom higher at this point and continue to see this expansion and optimism that is probably excessive at this point. That's why sentiment is on the risk side of the scale, or what would be healthier. And we're seeing some evidence of that. Not enough yet to really sink our teeth into, but some evidence in terms of these bull bear spreads, some consolidation, a modest pullback. We don't want it to fall apart. We don't want to see a sustained turn towards pessimism, but bringing optimism off the boil just a touch would probably be a healthy development for the stock market, especially as the S&P now it cleared the August highs. It's thinking about those Q1 and Q2 highs from 2022. It's going to be easier to move towards that if we don't already have excessive optimism that we're having to contend with. The problem with excessive optimism is that everything is expected to be rosy, and the moment you get even a little bit of a disappointment, whether it's from economic data or earnings data, that becomes some of a reason to sell. And so everything becomes priced in, and so disappointment is more easily manifested when investors are super giddy like they are right now. Focus just on what we're seeing from the AI data. A few squiggles here, a few squiggles there. The point here is 6 weeks in a row now of more bulls than bears. We haven't had more than 6 weeks in a row since July of 2021. So that this period of utter unlove from a sentiment perspective, we're moving past that. Now we've had this embrace, and it's quickly gone from a kind of a cautious embrace to a full embrace, probably too giddy of an embrace on the part of investors. Why do I say too giddy? Here, this is ETF flows. I think this tells a really important story. Over the first 5 months of this year, U.S. equities only received about 10% of all inflows into ETFs. The rest went to international equity and fixed income. Since the end of May, so over the past 6 weeks or so, 70% of every ETF inflow dollar has been into U.S. equities. In fact, it's like 80% of the year-to-date inflows into U.S. equities have come over the past 6 weeks. And so after being viewed skeptically for the first 5 months, investors now are rushing into equities. If we were in a position where after an extended period of time, investors were underinvested in stocks, then seeing this surge would probably be a welcome development. But that's not what we have right now. What we have, based on the AI asset allocation survey data, also confirmed by the data that gets released quarterly from the Fed, is that through this all, investors have maintained above average exposure to equities. It's bonds and cash that remain unloved. And so, yeah, we've seen this surge in inflows, but this isn't a surge in inflows from an underweight perspective. It's a surge in inflows from an overweight perspective. And so there's a question about how long that can persist, and whether or not that's actually the beginning of a sustained move higher, or just kind of that capitulation of bears, and have some optimism right here. We will have to see whether or not it can sustain itself But historically, when equity exposure is at elevated levels, forward returns are not above average. In fact, they tend to be quite below average. So that's the concern from a sentiment perspective. Is over the last 6 weeks, we've seen this dramatic shift from cautiousness to a slow embrace to just a full embrace, and look at put call data, and in fact, evidence of speculation, and some degree of fervor as well. From a trend perspective, this is our bull market behavior checklist. And we'll go into some of the details. The takeaway here is it's been noisy. We'll show you exactly how noisy in just a moment. But coming into this week, 5 out of 6, the only no was a percentage of global markets above their 50-day average. And thanks to the US dollar, that has, and the CPI data that we got earlier this week, that has started to change. So let's get into it. As a reminder, this is a mix of breadth data and price trend data in the US and around the world, trying to not get misled by one index or another and really get a sense of, broadly speaking, is the market behaving like it's in a bull market? 5 out of 6 now at the end of this week, it looks like probably 6 out of 6. Hard to argue that we're not, at least from a short-term perspective, seeing bull market behavior. This is what this indicator does over time, just to give a sense of the usefulness of paying attention to it. It's not a timing device, but it does do a good job of describing the environment. You can see in June, we got up to 6 out of 6. Next week, dropped down to 3 out of 6. Not a very healthy signal to see that surge and then a retreat. That's not happened very often in the past. Back up to 5 now. Likely to be 6 when we get the next update, in large part because weaker CPI data, weaker inflation data led to weakness in the dollar. You can see that here, and weakness in the dollar has helped. That's not been the only thing, but that has helped a surge in the percentage of global markets above their 50-day averages. And we look at that based on US dollar indexes, not in the local currency indexes. So that's surged from around 30% not that long ago to now 75% as of this morning. You see an uptick based on local currencies as well, but not nearly as dramatic as what we've seen if we look at it on a US dollar basis. So seeing this surge, seeing dollar weakness, seeing the percentage of global markets surge above their 50-day averages, that's a pretty bullish indication for stocks, at least for right now. Zoom out and look at longer term breadth trends globally, and now, I mean, the ACWI now will be at a new high. This is last week's data. So last week it was just off its high. We'll have to see what happens from a breadth perspective. It had earlier this year been leading. Now it's starting to lag. Still in this consolidation mode. If the global environment is strong from a broad perspective, we should see this trend indicator start to turn higher. That is not to say that we don't see pockets of strength, because we do, just not necessarily in the areas that we have been seeing it earlier this year. We can look at it from a developed market versus emerging market perspective. Earlier this year was all developed markets, 86%, 83% at the peaks in terms of the trends, the uptrends in developed markets. Now we're seeing emerging markets start to break out. The trends are stronger in developed markets than emerging markets, but at the margin, you're seeing improvement in emerging markets, deterioration in developed markets. We can look at this from region by region as well. And not too long ago, it was Europe that was a standout. Asia has tried to take the lead, but what we're seeing right now is the Americas. So this is US and Latin America, and Canada. Canada is one of the weakest areas globally. So we'll look past that for right now. So it's mostly the US and Latin America that are leading to this surge in the trend indicator for the Americas. So we're seeing from an emerging market, we're seeing emerging market strength. We're seeing America's strength. When we get into the portfolios, we'll see that we've added some Latin American exposure from a discretionary perspective. That's why, because that's kind of the sweet spot from a global perspective right now. Emerging markets over developed markets, Americas over EMEA and Asia Pacific. In the US, while the globe is struggling, US trends are improving and continuing to tick higher. So that's a super bullish development to see that. I mean, it's not like a super bullish signal, but it's very encouraging. Maybe that's a better way to say it. To see that expansion after kind of this muddle through for most of the early part of this year. After initial strength, we had that period in late Q1, early Q2, where the talk in the US was about the few number of stocks that were kind of sustaining index level strength. I think this was a good representation of that. You saw that lack of strength from an industry group trend perspective, even as the S&P 500 was near its highs and trying to break out. Now we're at a position where the leaders are still leading, but the followers are following the leaders, not moving in an opposite direction. And so from a breadth perspective, from a trend perspective, it's important to remember, yeah, we don't want to fight the Fed, but we also don't want to fight the trend, don't want to fight the tape. The trend for the S&P 500 has turned higher. The trend in our net new high advanced decline line has turned higher as well. And so how long these last, I don't know. From a tactical perspective, is this something that we can embrace and lean into? Certainly. Another way to look at what we're seeing from a kind of beneath the surface perspective is a difference this year between what's happening in the S&P 500 and what's happening in the median stock in the S&P 500. Go back to the end of May. Median stock was down 2.7% year to date. This is after the first 5 weeks of the year, median stock was up 9%. So from mid-February to the end of May, year-to-date gain for the median stock moved from 8.9% to minus 2.7%. The S&P 500 didn't see the same sort of deterioration. It peaked also in February at 8.9%, muddled along, never went into negative territory, and has since been climbing. The good news, since the end of May, the median stock return year to date has gone from negative 3% basically to almost 7%. Since the end of May, the S&P 500 is up about 7.5%. The median stock is up 9%. Only fewer than 50 stocks in the S&P 500 are down since the end of May. So we're seeing this surge in participation, seeing this surge in strength as we go into the second quarter. That's an encouraging sign. That's the median stock catching up to the index. That's what you want to see in a healthy environment. And so as the median stock catches up, as we see more new highs than new lows, important to remember that our fear of strength model now has turned positive, and in fact is close to making a new high based on the signal based on the positive reading there. All the gains in the S&P 500 have come when we've either since 1990, either in periods where the VIX has been elevated or we've seen more new highs and new lows. The VIX is certainly not elevated right now, but we are seeing more new highs and new lows, and that is a tactically bullish tailwind for stocks. That's something we want to lean into and embrace, even if the weight of the evidence argues for caution. This is where we get into different time frames: strategic caution, tactical embrace of the strength that we're seeing. And where specifically are we seeing that strength? We're seeing it at the mid cap level. That's what we really want to focus on. It was the mid caps earlier this year that had a larger percentage of stocks with 50-day averages above 200-day averages. When that peaked above 70 earlier this year, it dropped below what we saw from the S&P 500, but now is climbing. Not yet back to where we were at the February highs, but heading in the right direction. That's an encouraging development, and encouraging especially to see the improvement that we're seeing in mid caps kind of take that charge, take the leadership charge and run with it. Seeing it from an industry group trend perspective, that's the blue line here. Mid caps are improving, didn't get as bad as they were at the lows, even though the indexes from an index perspective did get down to the previous lows. From an industry group trend perspective, made a higher high, and now we're seeing some expansion there. So we're seeing mid caps lead, seeing mid caps hold up really well right here. And so this gets into now what we've done from a discretionary portfolio perspective. On the left here, this is our strategic portfolio, update that every quarter, and our cyclical portfolio, update that every month. So we made changes, some tweaks here and there. We got out of Europe overall, and have moved into the Eurozone, added Latin America there, moved into mid-cap growth in the cyclical portfolio away from large cap value. But the key here is if you look at the overall equity exposure, it's still in the 50s. And these portfolios are benchmarked to kind of a 60-40 portfolio. So equity exposure in the 50s is a slightly underweight equity exposure. From a tactical perspective, however, we've been putting money to work for a while, and now exposure here is close to 90%. Only about 10% cash, no bonds, no commodities right now. And so that's what this difference in time frames, longer term, things that we don't look at as often, probably pays to be a little bit cautious still, given the message of the way of the evidence. From a tactical perspective, given what we're seeing in our fear of strength model, seeing what we're seeing from a sector perspective, didn't talk about this yet, but that sector, that all or nothing sector model, that's close to being bullish again, as we were at 9 sectors above their 200-day averages, and we're 8 now, but we're on the cusp of getting back above 9. That would also be a tactically bullish signal. So short term, embrace the strength. Longer term, having a little bit of money on the sidelines, maybe not the worst idea at this point. Notice, and we'll get to our systematic portfolio in a moment, but notice none of these strategic, cyclical, or opportunity have any commodity exposure at this point. We also have 0 commodity exposure in our Blue Heron allocation portfolio. This is our systematic approach. So looking just at price trends, and when we just look at price trends, and given that price trends are the strongest part of the market right now, we're above average exposure to stocks. We're at about 70% exposure, and the average here is 55%. So we're overweight stocks, roughly neutral weight fixed income, underweight commodities. So whether we're looking at from a systematic perspective or discretionary perspective, commodities are not making the case for a portfolio inclusion at this point. We don't want to forget about them. That's a risk that happens a lot, is you take something out of the portfolio, you forget to consider adding it back in. So we keep them part of the conversation, even as they aren't part of our portfolios right now. A reason that they're not part of the portfolios right now is their commodities are one of the few areas in the world where we're actually seeing declining trends. Long-term treasuries also have a falling trend. Canada, I mentioned that being kind of the weakest of the global regions. Canada also has a declining long-term trend. So is more green than pink here. That indicates more uptrends than downtrends. In this environment, we want to lean towards the uptrends, avoid the downtrends. That means steering clear of commodities right now. And so that brings us, just to wrap up, to commodities and what to make of them. It was not that long ago that we're talking about commodity super cycle. We had this 95 weeks in a row of an uptrend in commodities, is most sustained uptrend in, showing here going back to at least 2010. And now it's 33 weeks of a downtrend. What to make of it? Was that the super cycle? I don't think so. My guess is that we don't have the same sort of sustained downtrends that we had over the past decade, or the abbreviated uptrends that we had over the past decade. It doesn't mean that we need to always be in an uptrend, but if we look over time at the length of the uptrends and the sustainability of downtrends, I think as we go forward from here, we will see uptrends more persistent, downtrends less persistent than the past decade, which just reinforces this idea that even though commodities aren't strong right now and aren't arguing for portfolio inclusion, they do need to be part of the conversation as we go forward. So that's a monthly call for July. Lots of stuff that we covered. Just keep in mind a couple key takeaways here is we can look at the market and we can think about our portfolios from different time frames. That is not only is that not an inconsistent and unhealthy thing, I think it actually helps to to think about the world across time frames. That's what we've done with our dynamic portfolios. It helps embrace when we need to embrace strength. It helps us stay on the sidelines when we need to stay on the sidelines. Having some systematic overlays to really take the emotion out of the asset allocation decision, I think helps as well. What we've seen short term is an embrace of the rally, excessive optimism from investors, but we're also seeing strength beneath the surface. And so, in terms of the next major move in the market, I think it's how those two play out. Does excessive optimism and any sort of consolidation that comes from that weigh on breadth, and we get back to that environment that we saw earlier this year, where we see this major lagging beneath the surface, or do we have some volatility that brings like I said, brings sentiment off the boil, but breadth remains healthy? If that's the case, then we're set up pretty well right now for strength as we go into and through the remainder of this year. So that's a monthly call. Thanks for joining. We'll do this again next month in August. Beginning part of the month, maybe mid-month. But anyway, thanks for tuning in. Thanks for listening. If you've got questions, fire them into me. Happy to hear what's on your mind and help in whatever way I can. Have a great day, and I'll talk to you guys again soon.